Temporary buy downs. I know this has been, with rates going up, this has been a popular feature. So I don't know if you guys are all familiar with how they work, but the way it works is the seller can add a buy down incentive to help sell their home with a known cost rather than reducing the sales price. So it's just an option for the sellers. If they don't want to reduce the price, they can just offer the seller credit and just help the borrower get into the home. It allows them to have a lower rate for the first year or two. So the buyer enjoys lower interest rates for the first 1 or 2 years with significant monthly payment savings. A buy down subsidy can be paid for by the seller, which is normally how it works, or by the borrower, which is less common. And the reason it's less common is because then you run into a problem with passing QM. So generally speaking, it's going to be the seller that pays for the buy down. So we do allow a 2-1 or a 1-0 buy down, and we allow it on conventional FHA, VA, and USDA. Seller paid buy downs cannot exceed the max interested party contributions. The subsidy monies belong to the borrower. So it's great for the borrower because if they happen to refinance or pay off the loan before it's fully used, they get the remaining balance back in the form of a payoff reduction. So they don't get the cash back out of it, but we do deduct it from their payoff. So here's an example of a 2-1 buy down. So this is an $800,000 loan amount with a rate of 7.125 and a principal and interest payment of $5,389.75. So if you look at the 2-1 buy down, so the way the 2-1 buy down works is it's 7.125 for the first year. I'm sorry, if it were a 2-1 buy down, it goes down 2 percentage points for the first year. So 5.125 for the first year, 6.125 for the second year, and then 7.125 every year after. So for the first year, the payment would be, instead of 5,389, it would only be 4,355. So that's a savings of $1,033 a month for the first year. And then the second year, it goes up to 6.125 for a payment of 4,860. And then the third year and every year after, it goes back up to the normal payment of 5,389.
Wendy, and maybe it's a question which doesn't have basis, but what interest rate you use to qualify?
You qualify on the note rate. So in this case, it would be 7.125. So the borrower still has to qualify at that rate. They just get the benefit of coming out of pocket with a little less each month for the first, so they can kind of ease into their new payment. So like when you have a move-up buyer who's looking, who's or a first-time home buyer and they've been renting, they're trying to ease into that new mortgage payment. So this is just a good way for them to be able to do that gradually.
Okay, so this is temporary, but at the same time, there's a permanent buy down.
There is a permanent buy down where you can just pay discount points to buy down the rate. So that's an option as well.
But can seller pay for that?
Yeah, seller can pay for permanent buy downs. Everything just has to be within the, it can't exceed the interested party contributions.
Okay, there's a reason I'm bringing this up because from what I understand, permanent buy down allows you to qualify on a lower interest rate.
Correct. A permanent buy down, there is no fluctuation in the rate. You're just buying the rate down, period. So like if, like at 7.125, if that's normally like say par pricing and the borrower wants 6.5% and 6.5% is at 1.5 points, then the seller can pay that 1.5 points. And then the permanent rate is now 6.5%. So yes, so there is no, and you are qualifying at that rate. So it is a permanent buy down.
And how this is reflected? Does it reflects in the contract? Where this, how does everyone knows and lender knows that it will be paid by the seller?
Yeah, so the lock will show a discount point, and then the purchase contract will show seller credits to be applied toward, you can specify toward the buy down or toward closing costs or however. I mean, it can just be
general. Hold on, that makes a difference because you see, when you say for non-recurring closing costs, it's just the amount of money and then just given to. But here we're using this specifically because then you have to underwrite it as a lower interest rate. So it has to be reflected, and I'm repeating, does have to be reflected.
Let me ask you a question relative to the buy down, if I may.
Wait.
Why would one do that?
to
if they can
qualify.
permanently. Go ahead.
This is my point. You see, the permanent temporary allows you just have to have lower payments first year, second year, etc.
Right,
So
to qualify. So you might as well just buy it down permanently.
Can you answer you this question? I did about two with this buy down. Like in example, it depends of situation of the client. Like in my situation, one of the client she will have like increase her salary. She finished at university and she only start to work, and she needs at least 2 years to be get her income up. So for these 2 years, for her, she needs to pay as less she can, and it was one of solution. And then for second one, it's very experienced guy, and he said he just have this period 2 years because right now interest rate it's gonna be down probably within 2 years, so he can keep lower payment. It's more convenience, and he's gonna have like a better advantage than if he's gonna buy forever, because he still will do refinance, and we knows that probably rate will go down. This was like two cases. One case because they need for some period lower payment, and then they will be okay even though with full payment if rate not gonna go down. Second guy, like investor, he said, I am sure I'm gonna have after these 2 years a lower payment because I will do refinance.
Yes,
Okay, but this is answering what question what Dwight asked. He asked why to take temporary when you can get permanent. The difference, I think, Wendy, clarify please, is that permanent, you can do it only for 1 year,
no,
correct?
permanent is for all, if you're doing a 30-year fix, the permanent buy down is for the full 30 years. So you're buying down the rate. It's
Sorry, yes, of course. So you're basically buying down and you're paying. So now going back to Maya's situation. So why they need it if they could have lower payment?
Because they compare. If they're gonna use this money to be decreased first year for 2% and second one for 1%, it's still cheaper if they're gonna buy points forever. They have to spend more money.
I see. So now it says for seller, it's easier to make the deal rather than permanent compared to temporary.
right. And this,
Seller it's not really care. It's for buyer. This to buyer they calculate. We calculate if they're gonna buy permanent or if they're gonna use this 2-1 buy down. We compare numbers.
But
And
who
after
who is pay, Maya? Who paid for that?
seller
Seller, you see.
provides credit.
So it's not for
and
buyers. It's you
No.
calculate.
seller provide credit to the client, and client can use this credit whatever they like. They can cover it non-recurring, recurring closing costs, and plus buy permanent points. This is
see,
one
okay.
way. Second way, they can use this credit when we lock the rate. Sarah marked that we're gonna use this program to 1 buy down. But before to use this program, I just spoke with account rep and they calculate us in example to be used this program, how much it should be credit. It's specific amount, not less than they need or like not higher.
So after you got the number, you notify the agent, real estate agent you're dealing with, and they in turn present it to the seller. So seller knew if they want to sell this property, they're willing to give so much money, an exact amount, to cover this buy down. This is the case, right?
No, it was different. When client provide the offer, so it was one price and it was any credit. But then within the transaction, they just buyer's agent just try to I cannot say push, but they provide different reason why a seller should provide the credit for this deal. So, and seller, after back and forth, he just agreed that, yeah, he's gonna give credit to the client, to the buyer. Another way, how buyer will use this credit. This is buyer's choice. If he's gonna cover it non-recurring, recurring closing costs, if they're gonna buy points, if they're gonna use this program to one buy down, or 1 year buy down. It was choice of the buyer because he knows that he's gonna have credit from the seller.
Okay, this
Next
gives me,
step,
yeah, go ahead.
next step, we just start to compare which way it's better to use this money to buy permanently points for 2 years fixed, or just use this money for like 2 years to be reduced interest rate like for 2 points for first year, and it's dramatically reduced monthly payment, and second one as well.
Okay, what my point is like this, and I've talked to a number of real estate agents. They use this tactic for negotiation. Let's say property is listed for 1 million, and this buy down will be 25,000. They make a deal. They understand this and say, okay, let's make an offer for 1,025,000. So this way, seller will get this 25,000 if they'll be willing to pay. So in other words, you just move numbers around, which maybe is not right, maybe not kosher. We can use any ways we can call it, but this is what is done to enable to accommodate the buyers, to enable them to get lower interest rate. And therefore, in this case, qualifying is more important because then you can you'll be able to get a mortgage versus not if you can lower the interest rate. See, there's
No,
a different purposes.
Many. But when they qualify, they don't qualify for this rate, which for 2 points or 1 point less. They
No, Maya,
qualify
you're missing the point. Is this what I brought up from the beginning? At permanent buy down, you qualify at lower interest rate. You see, this is the difference. So people,
if they need it, yeah.
Exactly.
But
This is the point. So
but
the
you
point
know,
is,
maybe is a big risk if seller will increase pricing for 25,000. An example, if borrower provide 5% down and then appraisal not gonna appraise for this amount, and
I
client
agree
doesn't
with you. I agree with
assets.
you. Yeah, I agree with you. But the point is, this is how real estate agents see it. You see, you have to look from their point of view. It's from them. When you present it to them, this opportunity, they say, no problem. So in other words, this all this business was buy down. It's you accomplish objective, but there's a different ways how to look on things, and we have to consider all options.
I think the temporary buy downs, the subsidy, it would be lower cost than the permanent. And the good thing about the temporary is that the subsidy monies belong to the borrower. So if you're going to refi, you're going to pay down the principal with all that subsidy.
Yes,
So
exactly.
Okay,
If he
we
didn't
answered all the
use
questions.
if he didn't use all this money, this credit, like after 1 year, he get this money for 2 years because it's 2-1 buy down, and then after 1 year, he can do refinance. He still has the money from the credit because escrow company holded this money. Then what he can do refinance, and this rest of money that he have right now in escrow, he can lower it balance of the principal.
Very good. Okay, excellent. I
Yes,
think we covered all the bases, and good that we started the conversation. Thank you, Wendy. Okay, let's continue.
Okay, yeah, so I was just going to say that, so Maya's 2 examples were perfect examples of why you would use a temporary buy down versus a permanent buy down. So if your borrower needs help qualifying, the temporary buy down is not the solution because you're not qualifying at the lower rate. So that's not the solution. But if your borrower is just trying to ease into the payment, or you have less seller credit, this is a good way because it is going to cost less you still get the benefit, at least for 1 year or 2 years of a lower rate, but the seller doesn't have to come out of pocket with as much credit. So it's just another solution. And what Juan was saying as well about getting, that those funds belong to the borrower. So they never lose those funds. So that's another benefit.